Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited today to get started. We want to take a second just to verify the audio, and then we'll dive into the session. If you have questions or topics you wish to discuss, please chat those over now so that we can be sure to get to them all. Again, this is another session of the My Solo 401k Financial Daily Webinar Series. This is our second session of the day. So we go live every day with content. We're here to answer questions. So if you do have questions, whether on this topic or even unrelated topics, please chat it over now so that we can be sure to get to them all. We also would invite you to like this video because that'll help us to get the word out to other solopreneurs like yourself, other advisors who themselves might be looking to secure their retirement savings or to help their clients secure their retirement savings. Our goal is always to help you stop overpaying taxes and start building real retirement wealth. Today, we want to do that with today's topic, which is keep more of what you earn, the $83,250 Fidelity Solo 401k strategy. So as always, the presentation is being provided for educational purposes only, should not be construed as tax advice, not to be construed as legal advice or investment advice. And we would always, we would never discourage you from consulting your tax attorney and financial professional. So let's start out with eligibility. So in order to get access to the great features of the Solo 401k, which we're going to talk about in a moment, you do need to be eligible. So in order to be eligible, you have to be self-employed with no non-owner, non-spouse, full-time W-2 employees. So, for example, you could be an independent contractor, a freelancer, a realtor, a solo practicing attorney. So the first element is really you've got to report that earned self-employment income. So that's going to be income, for example, reported on Schedule C if your business is taxed as a sole proprietorship. Could be a single member LLC taxed as a sole proprietorship. Income reported on a W-2, for example, if your business is taxed as an S Corp or a C Corp, or in the case of a business that's taxed as a partnership, earned self-employment income would be income reported on line 14 of the K-1 that you receive from the partnership. So that's the first element of eligibility. The second element is that you have to have no non-owner, non-spouse, full-time W-2 employees. Stated differently, it needs to be an owner-only business. So those are the two elements. Now that leads to some of the top Solo 401k eligibility considerations, such as, do I need a separate entity? No, you don't. You could be operating as a sole proprietor without a formal legal entity. That's fine. Do I need to report earned self-employment income? Yes, you do. That's one of the key requirements. Is there a minimum amount of earned self-employment income? No, there isn't. So a solo 401k is not just limited to a big self-employed business. It could be a micro self-employed business. As long as you're reporting that earned self-employment activity with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any, you're eligible to set up a solo 401k. Additional follow-up questions might be, can my spouse or business partner participate as long as they're also reporting earned self-employment income? Yes, they can, as long as they're also, again, reporting earned self-employment income. So that would be, for example, income reported on another Schedule C, or maybe income reported on another W-2. Can I set up a solo 401k even if I also have a W-2 job, a day job? The answer is yes, as long as, again, you meet the eligibility criteria. So again, as long as you're reporting that separate earned self-employment income with no employees. So a solo 401k is available to side hustlers, even if the side hustler is participating in their W-2 employer-sponsored plan. So you can have your day job 401k plan and also have a solo 401k for your side hustle. Now, my solo 401k Financial is a solo 401k plan provider. What we're not is we're not an account provider. So customers come to us to get the advanced solo 401k features that our plan supports, to get the ongoing compliance support for the 401k that our team offers, but they'll have their accounts at the bank or brokerage of choice. So it's totally portable. So when we talk about keeping more of what you earn, the $83,250 Fidelity Solo 401k strategy, we're talking about customers who get the plan documents from us, but they have their accounts at Fidelity. So you can use Fidelity for the assets, for the investments, but use the My Solo 401k plan for the rules. So what you can do with your Solo 401k plan is dictated by the documents, because a Solo 401k plan is a legal entity. It's technically a retirement trust. So like any legal entity, it's what creates it is the Solo 401k plan documents. So we offer IRS approved Solo 401k plan documents that we draft specifically for your self-employed business. And our documents are going to allow you to do all the advanced features that our plan supports, such as the mega backdoor Roth, or the ability to take 401k participant loans, or the ability to claim $1,500 in Solo 401k tax credits, or the ability to invest in alternative investments, whether that's real estate, crypto, private placement, pre-IPO stock, etc. So why that pairing matters is that if someone were to go directly to Fidelity and just open up their basic vanilla Solo 401k, that means that it's going to be Fidelity's documents that govern what you can do with your Solo 401k funds. And Fidelity, yes, they offer a Solo 401k, but it's very limited. It doesn't support those features that I just mentioned, right? It doesn't support the mega backdoor Roth, doesn't allow for 401k participant loans, doesn't enable the solopreneur to claim $1,500 in tax credits. But you can have your cake and eat it too. Why? Because Fidelity will happily open up accounts for people that bring their own plan documents. So customers will, again, obtain the documents from us, but then open up the accounts for their Solo 401k at Fidelity. And we're very hands-on in helping customers open up the accounts. For example, we prepare the paperwork or guide clients through the process, et cetera, et cetera. Now, in terms of hitting that $83,250 strategy for 2026, that refers to the fact that technically those Solo 401k contribution limits could go all the way up to $83,250 for 2026. And how do you get there? Well, first of all, I think it's helpful to understand that there are different types of contributions that you can make to the Solo 401k. And the types of contributions that you can make are also dictated by the underlying plan documents. So at a high level, a Solo 401k plan does offer the highest contribution limits to any self-employed defined contribution plan. So any defined contribution plan that's available to self-employed individuals. There's no other plan that offers higher contribution limits. And part of that comes back to the fact that there are different buckets that you can fill up as the solopreneur. So, for example, if you participate in a day job 401k plan, right, one that you might have at a corporate job, the only type of contribution that you can make to your day job plan is the employee contribution, the elective deferral. And if you're 50 or older, you can also make a catch-up contribution. But when you're self-employed, of course, you're not just the employee, you're also the employer. So now you can also make the employer contribution. And then on top of that, if you've got a plan like the one offered by my Solo 401k Financial, now you can also make the voluntary after-tax contribution, which is how one makes mega backdoor Roth Solo 401k contributions. So let's break down how we get to $83,250. So the overall limit that applies to Solo 401k plans is $72,000 for 2026. It increased from 70,000 in 2025 to now 72,000 in 2026. But in order to be able to make even higher contributions, you need to have a plan like the one offered by my Solo 401k Financial that allows for catch-up contributions. So the catch-up contribution limit for those aged 50 plus increased from $7,500 to now $8,000 for 2026. So that would take you from 72,000 up to 80. But if you're age 60 to 63, so thanks to the Secure Act 2.0, you can now make what are referred to as super catch-up contributions if you're age 60 to 63. So instead of $8,000 as your catch-up contribution amount, now that's increased to $11,250. So that's how you could potentially get all the way up to $83,250. So within those different buckets, again, you first have the employee bucket. For 2026, that employee limit is $24,500. And if you've got a plan like the one offered by my solo 401k financial, that employee contribution could be made as either a pre-tax contribution or as a Roth contribution, or it could be a mixture. So you can diversify from a tax perspective. Some as a pre-tax contribution to reduce your taxable income now, additional contributions or instead of could be made as Roth. So they're made as an after-tax contribution. So Roth contributions do not reduce your taxable income now, but you've got that potential for tax-free growth. So some clients will make it all pre-tax one year, maybe switch to Roth the other year. Maybe they'll do a mixture. Again, it allows for that tax diversification. Now, one of the core principles of making solo 401k contributions is that you cannot save more than you earn. So, of course, you're going to be limited by earned income or W-2 wages, for example, if your business is taxed as an S Corp or a C Corp. So, like we talked about during the eligibility discussion, there's technically no minimum amount of income that you would need to be eligible to set up a solo 401k. So, even a micro solopreneur is eligible to set up a solo 401k. But your ability to contribute is a function of your earned income because you can't save more than you earn. Now you can contribute 100% dollar for dollar up to 24,500 as an employee contribution to the solo 401k for 2026. Now, of course, again, as I mentioned during the eligibility discussion, side hustlers can set up a solo 401k. So in other words, someone that has a day job, but also has a side self-employed business. So if that individual is making contributions to their day job 401k plan, that employee contribution limit applies across all the plans that the employee contributes to. So if they happen to be maxing out their contributions to their day job plan, they're not going to be able to make any more employee contributions to the solo 401k. And then on top of that, if you're age 50 plus, now you can make catch-up contributions. So again, if you're age 50 plus, the 2026 catch-up contribution limit is $8,000. If you're age 60 to 63 during 2026, now that's $11,250. Now it's noteworthy that if your W-2 wages are over the applicable amount, $150,000, those catch-up contributions do need to be made as Roth contributions for 2026. So of course, our plan allows for that. So that would go into a separate Roth account. Now, if let's say your business is taxed as a sole proprietorship and you don't pay yourself a W-2, even if you pay yourself more than 100, or I should say, even if you earn more than $150,000 of earned self-employment income, if it's not paid as W-2 wages, then that mandatory Roth catch-up contribution requirement would not apply to you. Now, this catch-up contribution limit is on top of the 72. Remember, that's how we get to potentially $83,250 for 2026. Now let's turn to the second type of contribution that can be made to the solo 401k, which is the employer contribution. Remember, when you're self-employed, you're both the employee and the employer. You wear both hats, so you can fill up both buckets, assuming you've got the self-employment income to justify it. Now, employer contributions are always going to be made as a percentage, right? The contribution limit is a percentage of the self-employment compensation, where you've always got to have that self-employment compensation to justify the contribution. But if you're making an employee contribution or an after-tax contribution, as we'll learn, you can contribute 100% dollar for dollar of your self-employment compensation. But if you're talking about making employer contributions, it's going to be a percentage. Now, the percentage that applies will depend on how your self-employed business is taxed. For businesses that are taxed as a sole proprietorship, could be an LLC taxed as a sole proprietorship. You first have to start out with self-employment compensation, where self-employment compensation is equal to your net income from your self-employed business reported on line 31 of Schedule C, less 1/2 of self-employment tax. So you got to run that pre-calculation. And we're fielding questions every day from customers. We're helping to run this calculation. Our calculator that's on our website will run it. So of that amount, of that line 31 of Schedule C less 1/2 of self-employment tax, you can contribute 20% as an employer contribution, provided that all the contributions that are made to the solo 401k, employer, employee, and or voluntary after tax, do not exceed the sum of, or I should say the lesser of, so the sum of all those contributions cannot exceed the lesser of your self-employment compensation or the overall limit. Now, if your business is taxed as an S Corp or a C Corp, your ability to contribute to the plan is based off the W-2 wages that you receive from the S Corp or the C Corp. Specifically, box one of the W-2, plus any pre-tax elected deferrals, not in box one and over in box 12. So of that amount, you can contribute 25% as an employer contribution. Again, provided that the sum of the employee, employer, and voluntary after tax does not exceed the lesser of your self-employment compensation, for example, W-2 wages, or the overall limit. Now, employer contributions technically can be made as either pre-tax or Roth. However, in our experience, virtually all clients that want to make Roth contributions would simply skip making the employer contributions and instead just make mega backdoor Roth contributions. Why? Well, it's easier to hit the overall limit because, as we saw here with the employer contributions, you've got to have a multiple in self-employment income to justify your contribution, because you can only contribute a percentage of your self-employment compensation as an employer contribution. Whereas if you're trying to make a voluntary after-tax contribution, you can contribute 100% dollar for dollar. So it's easier to hit that overall limit. Now, this employer contribution, as we talked about, it's going to count towards that $72,000 overall limit. Because remember, the sum of your employee, employer, and the voluntary after-tax cannot exceed the lesser of your self-employment compensation or the overall limit. Lastly, the third bucket, voluntary after-tax contributions. Now, this is how you make mega backdoor Roth contributions. A lot of people want to make mega backdoor Roth contributions. Mega backdoor Roth solo 401k contributions, the mega backdoor Roth solo 401k strategy, that's really just a marketing term. What you're doing, what you need to be able to do, so you need to have the plan documents that allow it, is you're first making a voluntary after-tax solo 401k contribution, which are then converted. So you then convert those voluntary after-tax solo 401k funds to either a Roth solo 401k inside the plan, or move the funds out of the plan to a Roth IRA. So it's a two-step process, right? You first make the after-tax contribution and then move the funds over to the Roth account, either the Roth solo 401k or the Roth IRA. Now, some people will take a waterfall approach where they'll first fill up the employee, then the employer, and then whatever's left they make as a voluntary after-tax contribution. Whereas others will just skip those first two buckets and just make 100% of their solo 401k contributions as a voluntary after-tax contribution. So again, as I mentioned, the voluntary after-tax solo 401k contribution limit, it's not a percentage. You can contribute 100%, dollar for dollar, of your self-employment compensation as a voluntary after-tax solo 401k contribution. It needs to go into a separate after-tax account. You need to have a plan like ours that allows for those after-tax contributions. And then second step, you move the funds to a Roth account. All right, let's stop. We're going to ask you to please like the video. That helps us to get the word out to other solopreneurs like yourself, maybe other advisors who might be trying to help their clients with these types of $83,250 strategy, making mega backdoor Roth contributions, et cetera, et cetera. So please like the video. Again, it helps us to get the word out. It tells the algorithm that the content is valuable. Let's also go through a question. We're going to field a question. So thank you so much for your patience. Thank you for bringing the question. Contributions on LLC, Schedule C is considered earned. However, after losses on Schedule E and my standard sections, my magic goes negative. Can I still contribute to the Roth? So it's based off of your net earned self-employment income. So if someone has multiple Schedule Cs, they've got to use the net number. Now, you don't have to reduce it by investment income losses, though, on Schedule E. Hopefully that helps. So let's field an example just to paint the picture. How are you going to get to $83,250 in 2026? Well, first of all, you'd have to be age 60 to 63. Then let's assume that you've got $100,000 of self-employment compensation. Line 31 is Schedule C, less 1/2 of the self-employment tax. Let's assume that you don't participate in another plan like a day job plan. So you can first fill up your $24,500 employee bucket because you can do 100% dollar for dollar up to 24,500. You're not making contributions to another plan like a day job plan. Then let's go down to the catch up. Let's say you make another $11,250 employee contribution because again, you're age 60 to 63. So now that's 34,750. Excuse me, 35,750. Then let's say on top of that, you make an employer contribution of 20% of that $100,000 of self-employment income because again, you're a sole prop, right? So that's another 20,000. So now we're up to what? 55,750. Again, just based on this $100,000 of self-employment compensation. And then on finally, the last bucket that you can fill is the voluntary after-tax solo 401k contribution bucket. You could do another 27,500, bringing your total to 83,250. So just based on that $100,000 of self-employment compensation, again, line 31 is Schedule C, less one half of the self-employment tax, this person is contributing $83,250, so over 83% of their self-employment compensation to the solo 401k. Now let's assume that you're not quite 60 to 63, but you're aged 50 to 59. So essentially, same scenario. Now you're going to be able to go up to $80,000. Amazing, right? So the key takeaways in terms of this contribution discussion of the $83,250 strategy is, first of all, the $72,000 limit that applies to employee, employer, and after-tax contributions. The catch-up contribution for those age 50 plus, whether it's 8,000 or 11,250 if you're age 60 to 63 in 2026, that's on top of the 72,000. So that's how you could potentially get up to 83,250. If you want to make mega backdoor Roth contributions, you need a plan that allows for voluntary after-tax contributions and then a transfer to the Roth. You can have the accounts at Fidelity or really the bank or brokerage of choice. It doesn't have to be Fidelity, but Fidelity is a very popular option. So our plan is totally portable. At the same time, we're very hands-on in helping customers open up the accounts at the bank or brokerage of choice. Okay, now let's go to JP. I just get a 1099 NEC as a side hustle, no EIN. I meet the requirements per all my review of your material. So yes, you don't have to have a formal legal entity. You don't have to have an EIN number for your self-employed business to set up a solo 401k. As part of the onboarding process, we will obtain an EIN number for the solo 401k, not for your business, for the solo 401k. That meets the IRS expectation. Can I still set up the EIN as LLC and still do the mega backdoor for 2025? Again, you can, work with your tax advisor, but you don't need an LLC in order to set up a solo 401k with us. And yes, you can still set up a solo 401k in 2026 and make those mega backdoor Roth contributions. You can make those voluntary after-tax contributions all the way up until your business tax return deadline, including any timely filed extension. You don't need to be paid to a different entity. You, as a sole proprietor, can set up a solo 401k. Solo 401ks are not just limited to businesses that have an entity. They're not just limited to big self-employed business. It can be a micro business for someone that's operating without a formal legal entity. There you go. Exactly. You don't have to hit the limits, but as your business grows, you're going to be able to get potentially to those limits. So if you make contributions to a day job plan, you're a side hustler. If it's a day job 401k plan, it's not going to reduce your ability to make voluntary after-tax contributions because that voluntary after-tax contribution limit applies at the plan level. The only exception to that was if those contributions were being made to a 403b. Great questions from JP. Thank you so much for the good questions. Thank you so much for the engagement. We invite you to continue the discussion on our community. We've got the largest community of solo 401k owners, solopreneurs, solo 401k advisors around these topics. We've got over 32,000 members. That translates to vibrant forums. We've also got a library of videos and webinars So there's a ton of ways to learn. There's a ton of ways to share the knowledge. It's totally free to join. All are welcome. You don't have to be a client. You don't have to be an advisor referring accounts to us. Just join the conversation. Once again, it's totally free to join. All are welcome. And again, we're going to ask you again, please like the video. Helps us to get the word out. Whether you're on LinkedIn or YouTube or X, Instagram. We were the first provider to offer a solo 401k plan that supports the mega backdoor Roth. So we do try to make it as easy as possible. We've been around since 2009 as a company, started offering the mega backdoor Roth back in 2013. All right, that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Thank you so much.